Best ever listeners, welcome to the Best Ever CRE podcast. I'm your host, Joe Cornwell, and today I'm joined by Ari Rastegar. He is the owner and founder of Rastegar Capital based in Austin, Texas. They are a vertically integrated real estate firm. It focuses on existing assets and new development of just about every asset type. So we have a lot to dive into today. Ari, how are you? Welcome to the show.
Doing great. Living the dream, brother.
Well, we appreciate you being here. I know you mentioned it is your first time on the show. So why don't we spend a little bit of time introducing you? You know, who are you? Where are you from? What did you do before real estate? And then how and why did you get into real estate?
I appreciate the question. I'm an attorney by trade, and real estate is kind of everything is the joke, right? You know, no matter where you go from technology to any other type of asset class or investing, it has to exist on real estate. You know, you drive a car on real estate. I'm sitting in a podcast booth right now in real estate. And so understanding that nuance of where, you know, people, businesses live and exist is quite literally the foundational piece of any other asset class or any other investment module that you want to be in. So this was like the foundational piece for us to understand how communities are built, how people live, how they work, how they play, and letting that be the centerpiece to build off other ancillary verticals that all streamline from this, you know, kind of original impetus.
So what year did you go to law school? And what type of law did you initially get into?
Yeah. I mean, I started, you know, delivering pizzas and flipping burgers, and I don't think I was smart enough to get into Texas A&M directly. So I had to go to a couple community colleges, and I was actually an English literature major in undergrad and did my master's degree in Mexico in international business, and kind of moseyed my way into St. Mary's Law School in San Antonio, Texas. And I've kind of grew up in this golden triangle of Texas. I was born in Austin, raised in Dallas, went to law school in San Antonio, went to Texas A&M. And so much of our portfolio is around the markets and the people and the neighborhoods that we really know and understand. I think it's important to, you know, looking at the numbers on the spreadsheet, you know, you got to have sharp pencils, you got to know your numbers, but there's so much intangibles about the real estate business that goes to understanding, you know, the human element. Because at the end of the day, real estate is about people. You know, I've said this for years and years that, you know, until they can digitize me, which looks like they're doing pretty good, you know, it's still going to really be about people. And when I was in law school, driving, you know, back and forth to school around 2005, 2006, 2007, which led up to, you know, the world melting down, and things were just moving throughout that San Antonio area. And I was able to borrow, you know, use my scholarship money and $3,500 to buy a single lot in Spring Branch, Texas, which is a little north of San Antonio, kind of south of Austin, and partnered with a local developer and basically said, well, look, I got this land that I bought for, you know, plus or minus $4,000, and was on the build site every morning at 5 a.m. before going to school, and built a little $118,000 retail, kind of first starter house, and learn kind of the nuances. And then building one house, you know, all those components to build one house are the same components to build much larger buildings, you know, when it comes to the grading, the geotechnical, the concrete. And it was a good microcosm learning exercise for things that we've done that obviously have been substantially larger.
And what you said, what year was this?
2006.
Okay. So, you know, that's an interesting introduction into real estate, right? I would say most people don't go out and just buy an empty plot of land and then, you know, find a developer to build a house. So, I mean, what was the mindset behind that being your first investment in real estate?
I think maybe a little, you know, delusions of grandeur, maybe.
Yeah.
And a little bit of masochism of thinking that law school wasn't hard enough, that having an Iranian father and an Iranian mentality, being an American, that I need to try to abuse myself as much as possible.
Okay.
You know, and I've always seen, you know, real estate as something that was very aspirational. And there was an opening, you know, you were driving down during that time and it'd say, you know, house for sale, sold, house for sale, sold, house for sale, sold. And it created a level of attraction that made it seem like it could be possible. And I think a lot of that was rooted in being naive and being a little, you know, more arrogant than I care to admit. But the opportunity did open itself. We did it and we did make money. So, yeah, you know, a broke clock is right twice a day also.
Yeah, I love that mindset. It's like the more I learn about real estate, the more I realize how little I know. And I also look back at the past of like some of these big gambles I took, thinking that it was like an absolute sure thing. And knowing what I know now, I'm like, man, that was insane. Well, then it was insane that I did that. Then it was even more insane that I did that, you know? And it's like you can kind of look back at your journey and realize that I had confidence because I was so ignorant, you know, and it's almost you know, it can be a blessing certainly when things go well. Okay, so you buy this first lot again, very interesting, kind of unique intro to real estate. How did you find a developer and convince them, presumably to carry the cost to build this? If I'm understanding you right,
Sure.
like, how did that even come about, and what was that conversation?
Well, of course, in 2006, I used Chat GPT and used artificial intelligence.
Right.
It was pretty analog. There was a lot of signs that said Dugan Construction on all these different houses in the neighborhood that I was living in.
By the lot you
Yeah,
were
it just said
okay.
Mitch Dugan, who's still a good friend of mine, you know, had his name on every lot or house seemingly in the area, and I just kept seeing
now,
the
was
same
this a
name.
broker or was this a builder?
He's a builder, and you
Okay.
know his wife, you know, has kind of her real estate license. It's just
Gotcha.
very much a family business within this like Wimberley, Spring Branch, like these outskirts of like the San Antonio kind of MSA.
Okay.
And I just saw his name on everything, and I showed up at his office and basically was like, "Oh, you're the." I was like, "Well, what do you want?" And I was like, "Well, I got this, and I don't got much else." And he, because I guess he was building all the other houses in this little community, this one was right within his bailiwick, and took me to the Security and Trust Bank and co-signed on the loan. And the deal that we had has been a deal that I've stuck with, you know, for almost since then. Was, you know, I'll put up the land, you know, we'll get a loan on the property, we'll co-sign, we pay back all the hard costs, we split the profit 50-50. And that's been my deal with some of the biggest institutions in the world. Is, you know, we're not going to charge a bunch of upfront fees, acquisition fee. You know, I always say we're not in the capital raising business. We're not, you know, we're in the performance business. You know, you know, fees and stuff, it's great. You do need a certain amount of fees for, you know, for the business to run, but we'd much rather, you know, bet on the promote and bet on the success of the project and saying, look, if we do well, we perform, we'd like to be paid handsomely, you know, for our work. But, you know, if it's not going to turn out as well as we hoped, you know, we can both lose together and we can both win together. And I think that's very much the spirit of the partnership that we've had over the years. And I think it's one of the reasons why we've grown, you know, as quickly as we had, is because we've had that performance-based, like, alpha trading mentality.
How old was he at this time? Just out of curiosity, I'm trying to this conversation.
I would say mid 50s.
Okay, so he's obviously quite a bit older than you, and you're, you know, sounds like a college kid, right? That kind of walked in off the street with basically no understanding or experience, and he just took you down to the bank and said, let's sign a contract and do this. Yeah,
it sounds rudimentary, you know, when you say it like that, but it's exactly how it worked. You know, in Texas, you know, being born and raised in Texas is done with a lot of handshakes and a lot of personability. And there's so much to be said about just that feeling. He'll tell you to this day, as I said, we've been, you know, friends now for almost 20 years. And he'll say, I knew from when you walked into my office that he's like, I know that look, you know,
this guy I want to work with.
I know that look and I know what it is. And, you know, he'll say that it wasn't a gamble, that he thought it was a sure thing, which was a very kind and thing to say for, you know, a punk kid pulling up at a Ford Focus, you know?
Yeah. No, I love that. So, I mean, I didn't plan on spending this much time on this first deal, but it's very interesting to me, especially from like a psychological standpoint. So it's like, you buy this in 2006. I assume at what point does he break ground on this build?
Oh, we broke ground in 3 months, because so many of those houses, you know, they had their plans for the architecture, the type of house, the type of, you know,
so they already had layouts.
Yeah, they had layouts. They had an infrastructure. And I didn't know all of that at the time, but it became very clear that it was like, oh, this is the lot. You paid whatever. Boom. Here's the thing. File the permit. And I mean, I want to say within 3 months, you know, we were building. And then, you know, 12 months later, the house was done. You know, we sold it pretty much right when it was done and bought another one. Did a second one.
So that was my question. So you sold this before the bottom fell out of the market?
We did. We had sold both of them before, and I made like $13,000, which was, you know, more money than I've ever seen in my life. And and of course spent every dollar of it to do it again.
Yeah. Okay. So it sounds like you did a couple of these this first couple of years, these new
did.
builds on these in these single lots.
While going to law school full time,
yes.
and I'm pretty sure I graduated #1 in my class too. So,
well, great. Well, that's awesome. So yeah, certainly you can multitask. It sounds like. What year did you graduate law school?
2008.
Okay. And then were you still in the process of these deals, when the market did collapse?
No, we sold out before by sheer luck.
Yeah.
And I actually graduated a semester later than was initially planned, and then took the bar exam in 2009, passed the bar by the skin of my teeth. But after all that stuff, all the additional costs and, just things happened, I ended up on my, best friend since we were little kids couch. And he actually paid for my law school bar exam preparation course. And I think mostly to just get me off of his couch. And he's now the chief of staff of our firm.
Okay.
But yeah, there was definitely some ebbs and flows where, there was a lot of things, but a clear path was not one of them.
Okay. So when did you get back into real estate after obviously, getting, it sounds like a job in the legal field and all of that? Like, what was your next investment?
My next investment in real estate was about 4 or 5 years later. I had a pretty significant entree into the entertainment business, which incidentally was financed by a major real estate player in New York City that my wrestling coach, who I still talk to just about every day, introduced me to. Is this kind of Italian cousin in New York that was kind of running the world on the real estate finance side. And they funded a international entertainment business that I wrote an entire book about, which is called The Gift of Failure, which should tell you exactly how that worked out just simply by the title. And by building those relationships in New York, I got to know some really great operators in various niche markets, like in Connecticut or actually down in Austin when I was living in Manhattan. So even though I was born in Austin, my connection back to Austin really wasn't there. It was kind of reconnected in Manhattan. And I thought that maybe we could go out there and do something because of those relationships. So I started kind of raising capital by sitting up at the bar at Il Molino in New York City and getting to know the bartenders and, knowing just kind of just high net worth folks that sat in there, and had the harebrained idea to put a little LLC together. Later on, I learned that was called a fund to fund and aggregating some capital, and got to know these operators and said, hey, can we have a little piece of this or that? And started investing in different multifamily projects and commercial stuff in Austin and in Texas. And they sold. And when they sold, we made some money, and Major ended up joining us, who's my chief of staff. And then one thing after another, we transitioned from a fund to fund over 2, 3, 4 years into buying smaller, Class C multis, and parlayed that into bigger developments. And, we've delivered, I guess, over 1 million square feet of new construction over the past, I would say, year or so, from a massive industrial project near the F1 track or the Gigafactory in Austin. Our LP in it is one of the largest real estate investors on the planet. CIBC financed the construction. We leased it up, and it's gone pretty good. We're done horizontal construction on 318 acres in Kyle, Texas, just south of Austin, building 1,400 multifamilies, 1,000 new residential houses, a huge Texas town square. We just finished an elementary school, have another 4,000 multi-units in pre-development on land that we already own today. So we're, thank God, busy.
So when you say we, I know your firm, what specific role within these developments does your firm control?
I mean, we own it soup to nuts. I mean, we bought this land on balance sheet. We've gone through the zoning and the entitlement, which has really become our niche. I'd like to say, my old partner used to say, if you ever say anything good about yourself, you have to say, if I do say so myself. And if there's one thing that I feel like we do better than just about anybody in the state of Texas, I should nuance, because of those relationships, because of just living here my entire life, like speaking Texan, is a nuance. Same as, I guess, walking into New York or in LA, like there's, certain circles and cadences and language and protocols that the natives understand better. And I think we have that here, where zoning and entitlements has really been something that we've done incredibly well, of being able to look at a piece of land, look at an old apartment complex, look at a site in a given area, and reimagine what it could be based upon where the demographic, the growth, and the society or the pocket community is really going. So we rezone projects from in the office sector and industrial, master plan communities, super tall skyscrapers, like a project we're doing in Dallas, and which really helps you understand what the community is going to need, because laws at any given moment, and zoning is law, all of real estate is contract law, period, hard stop. Laws are about the given needs of a society at any moment in time. That's really what a law is. And a zoning law is just that, to say, well, if you could build a, 20-foot commercial property on XYZ site, but now there's super talls everywhere and 5,000 new employees moving it across the street, there's a case to be made to the community, to the owners in the area of, hey, there's a better use to build a 400-foot apartment complex here versus an old nightclub from 30 years ago. And here are the reasons why. And so understanding that human element, speaking to the community, getting affidavits of support, making your case, to the city council. Yes, there's a tremendous amount of, profit and alpha growth that investors reap those benefits. But at the end of the day, it's about building the right thing at the right time for that community, because all these projects, live and breathe and, quite frankly, live or die around the community enhancement that they bring.
Gotcha. Okay. So, but your piece, as far as your company, is on the development side. So you're partnering with these actual builders or construction or development companies, from as far as on the construction side. You're bringing in third party side. Yes, you're bringing in third party companies to partner with.
The risk profile is not there. The risk profile, in our opinion, is we'd rather RFP those things and bring subject matter experts into those. There's so much nuance, as you can imagine, into building an industrial facility within this given, locale, building permit, codes. There's so much that goes into it. I have such a high level of respect for the, for the contractors that we work with, just with how intricate the logistics are of that operation. So we find a better risk adjusted return in purchasing the land, building the plan, getting the design drawings in place, going through the financing mechanisms, accessing the capital markets, and getting the best builders in the world to, and then of course our management team, our project management team, working on it, night and day. But the logistical operations, we think it's a better risk adjusted model to work with the best contractors in the world. Absolutely. Yeah.
So when you structure these, and obviously I'm sure every deal is a little different, but like generally speaking, are you bringing these, the construction company, the GC company in to do it on a equity basis? Is this a fee structure? Like how do you
it's
strictly fees? Okay.
It's strictly fees. And look, we're open to the ideas, but historically over the, dozens of projects we've worked on, whether from remodelings to ground up to whatever the nuance for construction is, it's a fee-based project that you work on at the beginning. And ideally you get a GMP, you get some surety on pricing, which is good for us, which is good for them. And then you just watch it very, very closely. But there's always going to be changes. There's always going to be change orders and thinking this stringent idea of what you hope it would be. I think learning for us to be more of a bamboo tree than an oak has helped us be more flexible, be very sturdy on your goal and the objective and what those end numbers are. But you have to be flexible in that approach and be able to change with the nuances for the, really for the best outcomes.
Right. I mean, especially in the, the economic environment we've been in the last 2-3 years. I mean, there's just so much volatility, so much uncertainty. Obviously right now, we're looking at all these potential fallouts from tariffs. It's like, I think anyone who, and I'm in the construction business, that was my background and how I approach real estate from the construction side. But it's like when you look at the 6, 12, 18-month risk that could come in any new development, I think anyone who says that there's going to be some sort of fixed cost on anything is probably unrealistic.
Naive.
Yeah.
Yeah.
So it sounds like a good strategy.
And you build in those safeguards, right? Like you sensitize these things. And I think it's really about just understanding, you look at the deal and you understand where the bottom is, you understand where the top is, and you build in the cushions around flexibility of pricing. And, sometimes you get lucky and some prices coming low on our industrial development, which is massive. It's on 50 acres. at the time we pre-ordered a lot of steel, which was
Yeah.
real expensive at the time. And you have to be real strategic on these things, but again, also be very flexible and just understanding a range within the different pockets of the construction side from a pricing standpoint, from a labor standpoint, just understanding they'll can change. And right now that's, one of the greatest risks in the business is the uncertainty and this kind of, market freeze where, I kind of think of it like analysis paralysis. We're like, well, I want to do it. I don't want to do it. I don't want, and it creates the stalemate where throughout other cycles, like 2008 as an example, things were moving. Banks were either foreclosing, they were selling. There was transactional volume. And the thing about this market that is most concerning and quite frankly weird is that the transaction volume has just dropped off a cliff.
Just stagnating. Yeah.
Yeah. And stagnant water, we know what happens with stagnant water. It just breeds all sorts of stuff you don't want. So I'm looking forward to watching more of just the movement, whatever that is, like whether if the pricing looks, there's kind of opportunistic, and I kind of think that there's also vulturistic pricing. And so even if it's vulturistic, I just want to see things just move through the ecosystem. Yeah, just changing hands because, you kind of, marry that basis and you think that you date your debt in an ideal world, but those refinances get a little bit more difficult when the cap rates invert and all that boring stuff that nobody wants to hear about.
Yeah, no, I couldn't agree more. I mean, I think that's been one of the biggest challenges the last few years is that everyone thinks that there's going to be this big thing that causes change in the market. And people have been saying this for 3 years. Well, to this point, it hasn't really happened, right?
No.
It's like a lot of this has just been conjecture and hope. Or coping, with what could happen or what should happen or what everyone, has an opinion on what they think should happen with the economy. But one thing I've learned is that the economy is going to do what it does. And none of us on an individual level have very much control. I mean, we have effectively zero control over that. So yeah, couldn't agree more. I think everyone's sick and tired of just sitting around and waiting. But I'm working on my first development deal. I've done a bunch of kind of redevelopments, but this is my first actual component with ground up construction. Thank you. And so, something I'm definitely I'm very passionate about these types of conversations because one, I'm learning a lot with getting to talk to people such as yourself, but also just seeing how people are, almost from a philosophical standpoint, how do they look at development? How do they look at structuring these types of complex deals? How are they making numbers work in today's economy? As we mentioned, all the challenges we have. And so I know before we started today, you said your kind of special power was really on the zoning and entitlement side. Tell me a little bit more about that. What does that mean to you? Where do you see yourself, coming out ahead when so many other people cannot?
Sure. I think that really working with the neighborhoods and the communities from a place of active listening. And there's a way to do that because you have so many opinions when you think about city council, you think about these, non-official governing boards or committees, and people are not all motivated by the same thing. And I think it's very important that when you start really listening to all the different, whether from a condo owner to a convenience store owner to just people that have lived in these areas, but when you really start to listen, it gives the cues of what could happen. But zoning giving a dramatic example to understand the value creation opportunity is if, let's say you have 10 acres of land and the original zoning allows you to build one single family house, just using a number. Well, if you can go back based upon population growth or whatever the slew of factors there, and over the course of a year or two, you can now build 500 apartments, 50,000 square feet of commercial, and 50 single family homes. Would you think that the value of that land is higher?
Yeah, probably.
Probably significantly. Well, and think from a risk standpoint, just by doing that, have I built any of those apartments or built any of that stuff yet? No. But if you bought that land for X and it could build one single family home, and now you can build all those apartments and all those things, that value creation from a risk adjusted standpoint is exponential.
Yeah.
And then you could go and using financing mechanisms, you can parcel off a piece of it, you can de-risk, because in this day and age, protecting your downside is the most important thing. And zoning, if done well, has an enormous downside protection mechanism by creating that value without taking all of the construction risk. And as you can imagine, the risk is profound whenever you're just with how many things go into building something, you know, from doorknobs to nuts and bolts and screws and sewers and there's just so much. So the more things that there are, by definition, the more risk that there's there. And again, there's risk mitigation factors. But what I love about this zoning expertise that we've really cultivated over the last decade, built incredible relationships in doing it, is done right, you can create massive value before you start to take some of that construction risk.
Yeah, no, I love that idea. Okay, so this sounds like a great transition here for our kind of good deal, bad deal segment. So why don't we start with the good deal with this line of thought? Give me a land development deal that you did and break everything down for us. You know, where it was, what did you pay for it, what was the business strategy, and then the outcome.
Yeah, I mean, I think a great test case is this 600,000 square foot industrial facility that we built. And the reason I say that is we bought the 50 acres when the F1 track in Austin has just been built. This is before the Gigafactory. But if you look at kind of where it is, like you have, you know, North Austin is here, South Austin is here, and then there's a tollway 130 that kind of, you know, loops around, that connects the northern part of Austin and the southern parts of Austin and the pocket communities. And so we believed it was pretty clear that over time, that area, this would become the industrial backbone of Austin. And again, my youngest daughter, Isabella, is 5 years old now. I thought, you know, when she was, you know, 1 or 2, when I was buying this 50 acres, that when she got out of college, this would be her problem, is the way. And so we had this belief. And so often, you know, I find that we've been right about what or wrong about when in some regard, or, you know, like there's these, you know, sliding scale, right? Where, you know, nobody has a crystal ball, certainly not me. But we believe that because of the population growth of Austin, because of where this tollway was built, because of the F1 track, there's a very high degree of certainty that over time, that 50 acres in this area for a couple $1,000,000 was going to be a good trade. But in reality, we actually overpaid at that $2 million basis by looking at it in a vacuum. Well, a few weeks after we bought it, the Gigafactory announced it was being built effectively across the street.
Wow.
You know, within what the crow flies. So all of a sudden it became my problem, where if the Gigafactory is coming there and all of the hype and the nuance that goes along with that, we thought, okay, there's something really interesting here. So how could we be a support system, or what could we do to help support that infrastructure? And so often, you know, I think the mistakes the plethora of mistakes I've made, I'm going to continue to make, are around something that have been something we should be doing ourselves, versus zooming out and saying what we're doing is at best a part of a larger plan. You know, you're a part of this community versus the thing that you are doing kind of unilaterally. So this was one of those, you know, very effective learning experiences and incredibly lucrative, because we said, okay, this Gigafactory is being built. It's so large. You have this huge brand, you have this evangelist CEO, you have all this notoriety coming. How can we sit back as a firm that's beginning to grow, albeit we've done some great stuff and, you know, made our clients great money over the years, but what can we do here to be a good custodian of this community building? Like, what would be something that was helpful? And fast forward, you know, we're the landlord to some of the big Tesla manufacturing companies, so that component parts that go into the Teslas down the road. So that exercise of saying you're a part of the whole, you know, and we are the whole in parts. What could we do? We went down this industrial kind of concept, went to the city. It is in the ETJ, but we said, look, how can we build something that's going to support what will become the industrial backbone? But at the time, it had a lot of risk on its face, because we were effectively striking the match on the industrial backbone of all of Austin and what the growth was going to be. So there was some risk. But once we put it together, designed the nuance, we met with, through a friend of a friend, which I would argue is one of the best real estate investment companies in the world. And they're private about their brand, so I won't say their name. You know them. They're top 3 biggest in the world. We got to talk with them, talk to their chief investment officer, and having a lot of people that are a lot smarter than us kind of look at the markets, carve into the numbers. They saw the vision with us as well before a lot of groups and wanted to be in Austin, coming down from New York City and stuff they've done in Miami. And at the time, we said, well, look, we need about 40 million of equity to do this, and we'll need, 50 million plus or minus of construction loans. And for a loan that big at that time, for me signing as the, sole general partner and them as LP equity, it was very helpful going through that process. And they said, look, we're not going to put up all the money, but we'll put up 90% of the money. And that was kind of one of those, we want to see if you got skin in the game. We know you have the land, you have the thing. We went through the zoning. We got a great stepped up basis for the work that we did, which we deserved. And that was the plan. We put up 10% of the money on balance sheet and had a couple friends and family come in and syndicate that parcel out a little bit and built it, leased it. And we incidentally have some pretty big indications of folks that maybe want to buy the whole building. And yeah, and it's very, very fortunate. The right timing, the right project, the right support mechanism, and the right thing for that community and that neighborhood. And now there's just been a whirlwind of industrial development throughout that corridor. So I think we got pretty lucky. But at the same time, I feel like as a native Austinite, as a Texan, seeing where Austin was and where it was going, we were in a unique position to have the heart-centered kind of gut instinct of where Austin was going to go.
Yeah.
And in this instance, luckily, we were right.
So you made an educated guess that you happened to get right.
So we happened to be a lot more right than
and quicker
than we thought we were going to be.
And
infinitely quicker.
Yeah. Got it. Makes total sense. Okay. So if you can, whatever you can share, what was the all-in project cost and what do you think it's worth today?
Well, we have audited financials and we use a third-party fund administrator out of Miami to do everything we do. I know I'd be killed for talking about any of those nuanced numbers, but I will say it's worth significantly more than what it costs to build it.
Do you have a multiple?
There's going to be a big multiple.
Okay.
And I'm being deliberately vague because when you have audited financials, and I know a lot of folks don't, there's so many valuation mechanisms and third-party reports that go in. When you have public pension plans.
Yeah.
You got to be careful about those numbers. So that's the lawyer in me. But I would say, cautiously optimistically, our investors and bankers are going to be remarkably happy compared to how some other deals in that area might be going.
Yeah. No, that makes sense. And so I know you mentioned that before. So you have public funds, pensions, all these things. And that was with this partnership and the firm?
No, separately. No, we have
that's something you guys...
Okay. Oh, yeah. We have institutional investors. Like we manage money for a lot of the firefighter pensions within Texas, which we're very proud to be able to serve them.
So tell me a little bit about that. How do you even go about building those relationships to work with funds like that?
Yeah. And, I've been pretty active speaking at various, conferences and, it's all about relationships at the end of the day. And all the public pension plans have financial advisors that, really sit as the custodians of the entire asset management plan. And, we've got to meet a lot of these advisors. We've worked with Fidelity, TD Ameritrade since the beginning. And I think one of the most important things that we have done, and again, this is the lawyer in me, is using a third-party fund administrator and having to where we don't touch any money. Our risk controls are for the size of the firm are second to none. And it's something that I'm most proud about. We don't touch any money. We have a firm in Miami, Florida called Industry FinTech. And there is no way for me to speak higher of these folks. They run businesses just better. The finance department, their accounting department, their reporting schedules. And, they do work from all the way from, artists auditing their streams on Spotify and doing drop shipping for merch to running all the numbers for massive construction companies in New York. They run our various SPVs and our projects to where if you're starting to run a business, starting to raise capital, I could not suggest more working with some sort of admin so that you have the right custodianship of capital, the right partnership agreements, escrow the capital, audit your financials. It is expensive. It does take time, but the biggest investors on the planet are not as concerned with how much you make money. They're adults. They know things go up, things go down, but they want to know that you are a custodian of capital, that you are a good steward of capital, that those risk controls, your due diligence protocols, your systems and your governances are there. And yes, they evolve and they've gotten bigger and better for us, but our risk controls is what has attracted some of the biggest investors in the world to put capital with us, when at the beginning you would think on its face for our track record and our nuance. And we have an audited track record investing in 38 cities, 13 states successfully. But those are the things that I think differentiate companies that become institutionalized versus the ones that are just out there doing deals, which I think doing deals and making money is fine. We were out to build a massive alternative investment platform that was backed with all these types of reporting nuances. And that's what we did from the outset.
What's, and that all sounds, like a great idea, a great system to have, in your company. But my thought is, at what point does that make sense for your average operator out there? Let's say
we started immediately. We started
there's no limit of assets under management or dollars raised.
Not.
Okay.
Absolutely not.
Now is this fee
if you
structure?
Take investor capital, okay,
mm-hmm.
you should be consulting with an admin. In my opinion,
okay.
There's just too many things that can go wrong. There's too many. And things go wrong. Like, this is a guarantee you're going to make money on everything. But what it does show is that you're a custodian and a good steward of capital. This is a mission critical concept, especially in this day and age of things going, people saying God knows what about whatever. Everyone has an opinion. Everyone runs their own, news panel on their Instagram feeds or this, that, or the other. But if you are a steward of capital and you are using investor capital, working with your local law firm, working with an accountant, working with an admin, but having other third-party disinterested in the performance, so to speak, of the deals involved in your projects is absolutely mission critical. And that to me is more important than even doing a deal, is setting up those foundational risk controls. And there is if you're big enough for someone to invest their capital with you in a deal, you are big enough to consult with the right lawyer, a securities lawyer, a local accountant, or an admin to help you put in those controls in terms of your documentation. When the capital is is received into the XYZ account, having your LLCs, having separation of church and state. If there's anybody listening here that's doing anything that maybe would take one thing away from anything that I've said, this would be the number one topic.
Okay. And it sounds like this is something that can scale with you, right? So if you're starting with a small fund, a small deal, whatever it may be, my guess would be the percentage of cost is obviously higher the smaller the deal.
Totally.
But
very
the complexity
expensive.
Will add cost.
It was expensive at the outset, but it's more expensive, to be doing it wrong, get sued, have missed some, unintentional misstatement of your finances or whatever. Things happen, but if you have the right eyes on it and the right disclosures and in a lot of integrity, you work through them. And I think that's so important right now, more than anything. And as I said, we use this firm in Miami. They're fantastic. There's a lot of other companies that do it. You pay a fee, of some sort, again, varying on dollars and size and accounts and transactions. But that is absolutely mission critical in some regard to have that. And we outsourced all of that from the very, very beginning, which allows us to focus on investment management. We focus on running the deals. We don't have to be in the nuances of the, the day-to-day financial finance, core finance and accounting mechanisms that go into running a large private equity firm.
Gotcha. Okay. All right. And before we run out of time, I do want to get to a deal that did not go as planned, maybe one that was painful or, lost money, whatever it may be. Do you have one in mind that sticks out?
I think that it's more a philosophy than anything. Like, we've been very fortunate that, our deals have done pretty well. But I think that one of the biggest learning experiences for me was understanding how debt works on real estate deals in general. And you all heard the the famous quotes about compounding interest and, how compound interest that you invest it and you can make these large compounding returns, the rule of seven and all these things you've heard. Well, I guess being a dumb English major and being a lawyer, I didn't think about the compounded interest of how your debt mechanisms work. And I guess in hindsight, it's pretty embarrassing to think, well, this is why the banks run the world because of the compound interest they get from issuing debt, and thinking of them as, your lenders, as they have investors that are investing in these debt mechanisms. They're making money on the compound interest. And I think early on, getting some interest, some loans that had higher interest rates than maybe traditional banks. And some of that, when you're building your credit, you're building your balance sheet, you just don't have access to some of the best rates and debt because, you're just not there. So you're building your credibility with the banks, but really looking at how, when the deals do take longer, the COVIDs of the world happen, black swan events, happen. And we've had several black swan events in the last 5 years. I mean, COVID by itself, and then rates staying too low, too long, raising too quick, too fast, inversion of yield curves and all that other hoopla. You come to see that when a deal takes longer than you thought, that compound interest on that debt can kick your ass. Certainly. So I am so much more diligent now about understanding the fine print within the loan mechanism. So when you get a loan, it's very easy when you're entrepreneurial and you're doing this and we got a loan, thank God. But when you start getting into, the big print gives, the fine print takes away.
Yeah.
And so get your magnifying glass when you read those documents, and none of it's nefarious and none of it's, but it's us as being the issuers, us being the custodians of capital, us being the managers, and being the ones that sign on the bad boy carve outs or sign on the personal guarantees is to, and I can't say that enough. The big print gives, the fine print takes away.
Yeah. And, one thing I've kind of noticed and really resonated with me the last few years is that when the financing terms change in our economy, right? When interest rates went from 3 to 8% in, 18 months, it's like, it feels like now as operators, we're working for the banks more than ourselves, and even at times more than potentially partners or investors, right? So it's like, the banks used to have a real small piece of these deals as far as from a capital stack standpoint, or from a debt service and capital allocation standpoint. Now that's shifted. Now it's effectively you've almost tripled your cost of capital from the bank standpoint in a very short amount of time. So yeah, that was something that I don't necessarily, I was able to put really well to words, but it was a feeling of like, I'm looking over our accounting, I'm looking over statements. I'm like, man, I'm busting my butt and I'm making way more money from the bank than myself, and that didn't feel that way 5 years ago.
Yeah, no, you're totally right. And, the debt mechanism, and you look at the capital stack, right? And you just take a traditional multifamily acquisition, right? You say 65% LTV just to keep it middle of the fairway. 65% of your capital stack is the bank.
Yeah.
So there's an argument to be made that 65% of your focus should be on not only managing that relationship, but understanding all the nuances of how those debt mechanisms work. What are the escalations? Things that I think earlier I certainly didn't look at with as much diligence. You think, oh yeah, after a year, you'll extend the loan. You maybe pay a little thing or, but now as things have taken so much longer, you start looking at some of those steps of, oh, if this takes longer than this, the rate goes up 100 basis points. If you want to get an extension, you have to pay a 1% origination fee or whatever. But I think this is an enormously good opportunity and maybe a necessity for operators to read their loan covenants.
Yeah.
And it's nice to have a lawyer, but you have eyes, you can read, and we have this incredible thing called ChatGPT. Go in, read your loan documents, understand them, and don't be blindsided. I can certainly tell you that I myself, embarrassingly enough, going back and seeing when loans need to be restructured, which they need to be, getting extensions and, the whole, kind of extend and pretend epidemic that is the commercial real estate business at this time, which happens in cycles. That's the business, is getting familiar, with your documents. As boring and dumb of advice as that sounds, is yes, you read your partnership agreements, your limited partnership agreements, you understand your obligations to your investors. But as we said, 65% of your investment base is the bank.
Yeah.
So understanding that relationship, the mechanics of it into the fine print, I think is a priceless exercise, especially if you plan on doing billions and billions of dollars of transactions over the coming years.
Yeah, I mean, it's really the bank's property that you happen to be managing right now. I mean, that's one way to look at it for sure. All right, we are running up on time. So, Ari, thank you so much for all of your stories and wisdom, your background. I've really enjoyed our conversation. But before we go, can you tell our best ever listeners a little bit more about how they can connect with you and your business?
Sure. You can go to rastegarcapital.com and learn about the projects we're doing. We have several active deals at the moment. Although our investors are predominantly public pension funds and insurance companies, we've created a very unique method that allows accredited investors, and soon to be, we have some other structures that we're launching over the next 90 days that I think will allow a much broader investor base into the projects to co-invest. And so, a lot of times accredited investors, the deals that they have access to, surely because of the size of their investment amounts, aren't always institutional grade. Sometimes they are. And so what we're trying to really lean into is having the ability for ordinary investors to invest alongside the greatest institutions in the world because of their due diligence, because of their things. And again, that doesn't guarantee that everything goes great, but it does increase the probability that ordinary investors are able to participate in fantastic projects that have had a lot of really smart eyes on them to increase the probability of their long-term success.
Yeah, that's fantastic. Well, again, Ari, thank you so much for your time and joining us today.
Thanks for having me, bud.
Best ever listeners, thank you so much for tuning in. If you enjoyed today's episode, be sure to leave us a 5-star review and share this with someone who could value from it. Make sure you're following and subscribe to the podcast so you don't miss any. Thank you for listening. Have a best ever day.